Welcome again, and we are going to discuss today section 40 disallowances. Very important section from PGBP perspective, and this is completely a unique section. Till now, what we discussed? We discussed about section 28, and what I said that section 28 talks about incomes, right? And then I spoke about section 30 to 38. So section 30 to 38 talks about expenditures. And we all know income minus expenditure, you will get business income. But here there is a catch. Section 40 actually interrupts you. It says, no, section 30 to 37 may say that expenditure is allowed. But if you don't listen to me, I'll not allow. That's what section 40 says. Basically, section 40 has a connect with one chapter called as TDS, tax deducted at source, and some other reasons also. It says that if you satisfy certain conditions, then I don't have any problem. You claim deduction under section 30 to 37. But if you don't meet that conditions, then even though 30 to 37 may say that the expenditure is allowed, but I will disallow. So section 30 to 37 says that you can debit it, you can deduct it, but 40 says I will not allow. That means if you have deducted, I'll add it back. If you have debited, I'll credit it. Like that it says. So this is what section 40, disallowances. And if you go to the Bare Act and read the language of section 40, what it said, notwithstanding anything contained in section 30 to 37, 38. That means what? Whatever is written in section 30 to 37, this section, that is 40, overrides. That means dominates. In our language, dominates. In legal language, overrides. In our language, dominates. So that means what will apply? Section 30 to 37? No, 40 will apply. Okay. So this is how they explained. Now let me take up one after the other, each and every aspect. Let me simply tell you that what actually you are going to do. See, section 30 to 37 says expenditures are allowed as deduction. So you will deduct it as per section 30 to 37. But if section 40 conditions are not satisfied, whatever is deducted, you have to add it back again. Right? So that means deduction is not allowed. Okay? Right. That's why not allowed, they used the word disallowed. Okay? Let's continue. Interest, royalty, fees for technical services paid outside India or to a non-resident. This is covered in section 40, small a, right? And then clause 1. So section 40, small a, clause 1. Why I am saying small a now? Because later on capital A will come. That's why. Okay. If I simply say 40A, then is it small or capital? Confusion will be created under this section. So that's why when you read or I read, we should say section 40 small a. If it is capital A, later on it will come. You say section 40 capital A subsection 2. So like this we should read so that tomorrow confusion will not be there. Okay. So what is the first part? The first part is interest, royalty, fees for technical services paid outside India or to a non-resident. Let me discuss. Basically, interest, it's an expenditure. Royalty, here also it is an expenditure. Fees for technical services, it's an expenditure. Now tell me, is it allowed? Generally, interest is allowed under section 36. Royalty is allowed under section 37. Fees for technical services also allowed under section 37. Yes or no? But section 40 says that when you are paying any interest, royalty, fees for technical services outside India, so money is going from India to outside India, or you are paying in India but to a non-resident. Now, if you are making the payment like this, then it's your duty under the TDS chapter that you have to deduct the tax. And it's your duty that whatever you deducted, that you have to deposit with the government. So what I said, there are two duties. One is deduct the tax and second one, deposit the tax. But when to deduct the tax? Suppose your previous year is 2024-25. Of course, for our exams, 24-24 up 25, previous year is there. So, if you have to deduct the tax, you should deduct the tax in the previous year. Okay? And deposit the tax at least before filing income tax returns. Right? At least before filing income tax returns. So, whenever we learn some problems or do some problems in this topic, there will be dates given in the question. They'll give different dates. Right? The date of making the payment, the date of deducting the tax, the date of depositing the tax. So when you see these dates, you see when it is deducted. Is it in the previous year? If the answer is yes, then you see the second date, that is when it is deposited. Is it in the previous year or at least before filing income tax returns? If the answer is yes to this, then no problem. Section 40 will not interrupt. It will say, okay, claim the deduction. But if suppose you fail to deduct the tax, suppose you deducted the tax, but you did not deposit with the income tax department before filing returns, then in that case, section 40 interrupts. And section 40 says, you deducted it, you claimed it as expenditure, but will not consider, will disallow, will add it back. That's what section 40 says. Right? This way you should be able to understand. Then how much percentage? The answer is 100% of the amount is disallowed. Yani the entire expenditure is added back, disallowed. This is how you should understand. Okay? And practically in this video itself, I'll show you how the treatment would be done of all these sections while computing your business income. So that understanding concepts and observing how it is practically done will boost your confidence and the speed at which you solve the problem. Okay? Chan, let's understand some more points. What it says. Suppose example, the person deducted the tax but did not deposit. The person did not deduct itself. In both the cases, the amount is disallowed. But sir, they later on deducted it, sir. They later on deposited it, sir. After return filing, later on they deposited, sir. They are late. Then how can you punish them like this? Okay, they are late. No problem. They will get the deduction in the year in which they deposited it. The year in which they paid that TDS to government. Are you able to understand? Suppose 24-25 is your previous year, right? Tax is deducted in 24-25 and tax is paid, the TDS is paid to government before filing return, right? So if it is done, no problem. You claim the deduction of the expenditure. But suppose you deducted the tax in the previous year, that is 24-25, but you did not deposit it before filing returns. Maybe you forgot to deposit. Maybe the accounting process took more time to complete the task and you deposited after filing return. Then what to do? Then you cannot claim it as deduction in the current year, but maybe in the next year, the year in which it is deposited. For that year, you can claim it as deduction. No problem. देखो, ultimately, government don't want to trouble you, right? Government is there to support you. But if you create a trouble to government, if you hinder the process of tax collection, then obviously government has to be strict with you, correct? They create problems for you. But once you support the government by depositing the TDS with the PAN number of that person, then government says, very good, no problem. Right? So this is how the way of working is. Now, one more section is section 201, which I'll discuss. Suppose you did not deduct the TDS. Right? You are the payer. You did not deduct the TDS. But the person who is the payee, the person who is going to receive the money, filed the income tax return. He showed the income properly to the government. That means the purpose of the government is served or not? The answer is yes. So because ultimately you deducting the tax, what is the purpose? Government should get the tax. Now here you did not deduct, but the other party who is receiving, who is actually earning the income, he showed that income in his income tax return. He not only showed it, but he also paid the tax. If suppose he showed it as income in his return, he paid the tax for it, and you, the deductor, got a certificate, then definitely the government will treat it as that you deducted the TDS. You deducted the TDS. That's what government will feel. But when you deducted, the day when the other party filed the return. Okay? Let's try to understand. I have building construction related work. So I appointed Mr. Chotelal as the contractor to construct my building. Now I have to deduct the tax of Chotelal. I am making a 1 crore payment to him. So I am the payer. Chotelal is the payee. Now in this case what happens is I have to deduct the tax in previous year and deposit the tax before filing returns. Before I file the returns, I should deposit. If I do so, no problem. If I fail to do so, then whenever I do that year, I'll claim the deduction. Okay? Of the expenditure, of the payment which I made to Chotelal. Suppose I have to make 1 crore payment to Chotelal. 1% is the TDS rate actually under section 194C. Correct? So in that case, I should actually pay 99 lakhs to Chotelal and 1 lakh I should deposit with income tax department in the name of Chotelal. But did I do so? I did not do so. Then what will happen? My TDS will, my expenditure of 1 lakh, I cannot deduct it for computing the income. That means my income will be 1 crore more. And automatically I have to pay additional tax. But suppose example, I did not deduct the TDS now, neither I deposited before filing returns, but I did late. Next year I can claim the deduction of that 1 crore. What's wrong with it? One more situation may come that I did not deduct, I did not deposit, but Chotelal is so nice, the contractor who is receiving the payment is so nice, he filed the income tax return. He showed that 1 crore income in his return. And he paid the taxes on it too. Then I went to Chotelal, sir, I did not comply, but can you at least help me to get the certificate that tax is paid on that income? Then he'll talk to a chartered accountant. He'll issue a certificate to me. I'll get the certificate. I'll show it to income tax department. And income tax department will say, okay, Ganesh, we'll consider that you have deducted the tax. Ganesh, you have deposited the tax also, will bill you. And that 1 crore expenditure, you can claim it as deduction. Okay. This is what I wanted to tell. Now, understand practically. Here, when actually I have deducted and deposited the tax, the day when Chote Lal filed his return, because at that time only he showed the income, na? Right? This way you should understand. So first concept clear to you, right? I said interest, royalty, fees for technical services, right? Paid outside India or paid to a non-resident in India. Deduct the tax in the previous year. Deposit before filing returns. If you fail, then you cannot claim the expenditure as deduction. 100% expenditure disallowed. Okay. But if you pay later on, then you claim deduction in that year. If the payee like Chote Lal, right, who is constructing the property in Dubai for me, right, if he files the return properly and shows the income to the government, then definitely I can actually get the deduction even though I did not comply with the rules. Right? This is how you should understand. Now come to section 40A, small a, and clause 1A. Suppose if Chote Lal is not in Dubai, but Chote Lal is in India, then what will happen? Then obviously, any payment I am making to resident, it may be payment of rent, it can be payment of like contractor's fees, it can be payment of a professional fees like under 194J, like that any payment I am making in India to a resident. Again, on that TDS provisions are applicable. Now TDS provisions are mentioned mostly in section 192, 193, 194, right? For non-resident it is 195. Then some sections of 196 to 206 are also there. All sections are applicable. Now, if under any section, if I am making the payment to resident, TDS has to be deducted. I have to not only deduct the TDS in the previous year, but also deposit it before filing income tax return. If I don't do so, I am the payer, correct? I am obliged. It's my duty. If I don't do so, 30% of the expenditure is disallowed. Are you able to understand? 30% of the expenditure is disallowed. Now, there is a difference between clause 1 and clause 1A. Right? Clause 1 talks about non-resident or payment outside India. Clause 1A talks about resident. And the difference is there 100% of the amount is disallowed. Like I paid 1 crore to Chote Lal for construction in Dubai. Entire 1 crore is disallowed, cannot be deducted. If suppose already deducted, I have to add it back. But if suppose if that 1 crore is a payment to resident, then 1 crore will not be added. Only 30% of it. 30 lakhs will be added back. This way you should be understand. So non-resident को payment कर रहे हो, payment outside India है, तो entire amount added back. If you are paying to resident, only 30% will be added back. Now automatically, if suppose later on you comply with the conditions, right? You deducted the tax of the resident, you deposited the tax of the resident. Now you got 30% disallowance. Only that 30% will be deducted further. Are you able to understand? Right? This way you should understand. Now come to the third point. You see section 40 small a clause 2. Payment of income tax. Now we are studying income tax only. Now if income tax is paid, will we give deduction here? The answer is no. If you are either paying income tax, whether you are paying interest on income tax, whether you are paying any penalty under income tax, right? If you are paying cess, surcharge under income tax, or suppose you are taking any loan to pay income tax, the interest on the loan also. Oh, you have taken any loan to pay income tax. Interest on that loan also not allowed. So please remember, health and education cess, right? Surcharge, income tax, interest on income tax, penalty under income tax, fees under income tax, interest on loan taken to pay income tax. All this is disallowed. Now, income tax may be Indian income tax or income tax under foreign country. Not allowed. So, suppose example, you have already deducted income tax or provision for income tax you have deducted. So, in accounting language, we can use debited. Okay. If you have debited your P&L account with two income tax or two provision for income tax, then definitely that should be added back while computing your business income. But terms you should be able to understand. Okay. One more thing. Suppose you paid certain fees to a cost accountant or a chartered accountant to file your income tax return. Can that expenditure be allowed as deduction? The answer is yes. So you are paying a professional fees for a professional service. So if you are paying to a consultant, if you are paying to a professional to file income tax return for tax planning, tax compliance, that payment is allowed as deduction. Right. Now let's come to fourth point. Now here when I say disallowed, 100% payment is disallowed. Okay. And one more thing. Clause 1, clause 1A, they were conditional. If you meet the conditions, you will get the deduction later on. Right? Whenever you meet the condition, you will get the deduction. But this income tax related part is absolute in itself. That means you will not get deduction at all. Okay? This is how you should understand. Okay. Now this point is clear to all of you. I'll ask you that if you are an employee and you are paying professional tax to the state government, is it allowed as deduction? You are paying professional tax to the state government because every state government collects professional tax from the employee. The answer is this professional tax is not income tax, right? It is not collected by central government. It is collected by state government. Professional tax is collected by state government. So that is allowed as deduction. No problem there. Okay. This way you should be able to understand. Now let's come to the fourth point, that is payment of salaries. Again, this is covered, right? If you are paying salaries outside India or to a non-resident in India. Same concept like a non-resident, the clause 1 we discussed in the section 40A clause 1. Same here. But the nature of payment changed. There it was interest, royalty, fees for technical service. Here it is salary payment. Right? Conditions are same in both the cases. That the tax should be deducted in the previous year, deposited before filing returns. If you fail this, then you will not get the deduction. Salary expenditure, you cannot show or debit it in the P&L account. If you debited, we'll add back while filing income tax returns. Okay? While computing your business income. This is how you should understand. Okay? Now let's come to the next part. Suppose you are making payment of provident fund. Employer contributes to the provident fund of the employee. Employee also contributes to provident fund. But more than 12% is taxable. Na? Suppose employer is contributing more than 12% to the provident fund. That excess 12%, more than 12% is taxable. So, if it is taxable to the employee, then did employer make the arrangement to deduct tax on that? Is the question. If suppose employer has deducted the tax on it, he has included it in the salary income, total income, then whatever tax computation is there, accordingly employer did, then no problem at all. But for provident fund, if employer has not made proper arrangements to deduct the tax, then definitely the payment is disallowed. Right? Only the taxable portion is disallowed. Okay? Right. So disallowed when? If the employer made the payment of provident fund and that is taxable, for that employer did not deduct the TDS, did not make arrangements to deduct TDS for the taxable portion, then that taxable portion will be added back. Right? This way you should be able to understand, right? 40 small a clause 4. Right? 40 small a clause 1 interest, royalty, fees for technical services. Clause 1a any payments made to residents. Clause 1a हो गया. Clause A 1a. Section 40a clause 2 we discussed, income tax related. 40 small a clause 3, right, we discussed about salary. We discussed about provident fund in section 40 small a clause 4, and last one is clause 5. What it is? Actually it is easy and difficult both. I'll tell you. Employer gave a perquisite to the employee. Employer gave a perquisite to the employee. That means employer gave some facility to the employee. Maybe a house to stay in, maybe a car to travel, maybe employees insurance payments the employer has done, maybe any type of benefit which we discussed already in salary chapter. Now, out of the perquisite, some portion is taxable, yes or no? So the taxable portion will be included in the employee's salary income computation. And on that, employee is supposed to pay the tax. But if employer says, no, this benefit I have given, perquisite I have given, and on that tax also I will only pay. Who paid? Employer only paid. So now the perquisite related tax already employer paid. Now employee need to pay any tax on it? Need to show that income in his salary? No need to show. Why? Because it is taxable, agreed. But already employer paid tax, na? So do employee has to show it? No need to pay. Show. No need to show it in salary computation. Second thing, whatever tax paid by employer, is it a perquisite to, is it a benefit to the employee? The answer is yes, it is a benefit. But under section 1010C, it is also exempt in the hands of employee. So that means perquisite facility employee enjoyed. On that tax also employer paid. Right? So employee enjoys the perquisite without paying taxes, without showing it in the income. And the tax also is not a perquisite, is exempt under section 10C to the employee. So here employee enjoys. So when employee enjoys, employer struggles. Can employer show the tax paid as a deduction here? When he computes his business income, he paid tax on behalf of employee, correct? If employer says, I want to deduct this tax paid, the income tax department says, no, not allowed. Under section 40, small a clause 5, the tax paid is not deductible to employee. Sorry, not deductible to employer. Sir, employer wants to deduct it. He has deducted it, sir. Oh, he has already deducted. Then add back. Right? If employer has already deducted while computing the income, then add back. If it is shown in adjustments, ignore. Are you able to understand? Okay. So if he has deducted it, the income is affected. then add back. If it is shown in adjustment, then ignore. Right? This is how you should understand the topic. So now you understood that employee got the perquisite, he enjoyed the perquisite. On that, actually tax should be paid by employee. It should be included in the salary income. But because employer paid the tax, it's not included in the salary income, and the tax paid by employer is also exempt to the employee under section 10 subsection 10c. Correct? Very good. Now let me tell you, for employer's case, whatever tax paid, he want to claim it as deduction. But because employee got the exemption, employer will get disallowance. He cannot deduct it. This way we discussed. Okay. What practically it means, I'll show just after 5 minutes. We'll solve a problem and you'll understand. Okay. Now, excess payment. It's covered under section 40, capital A, subsection 2. Now, excess payment to relatives or related persons. Suppose example, the related person has to be paid for some service. So actually the payment should be 30,000 as per market price, right? But we paid 50,000. Now I am showing it that this is the 50,000 expenditure paid to relative for this service. If income tax assessing officer understands this, that this is going on, extra expenditure they are showing and trying to lower the income, pay less tax. In that case, the income tax department says, boss, unreasonable payment, excess payment, disallowed. That means you showed 50,000 as expenditure, but actually it should have been 30,000. So extra 20,000, excess unreasonable 20,000 will be added back, right? If it is debited to P&L account, if it is deducted while computing business income, then it will be added back. What will be added back? Is the entire amount added back? Is entire 50,000 added back? The answer is no. Only that excess portion will be added back. This way you should understand. Now, to understand this, they used the word excess or unreasonable payment to related persons. Now, who is related person? Obviously, a relative will be there. Or it can be a person having substantial interest. So, who are these two persons? Let us understand. Relative is defined under section 2 clause 41. And relative simply means husband, wife. They use the word spouse, but it means husband, wife. Okay. So spouse, brother, sister, lineal ascendant, descendant. That's it. So spouse, brother, sister, lineal ascendant, descendant. This much is relative definition. Now, what is person having substantial interest? Because substantial interest means some reasonable control one has over other. Right? This is called as substantial interest. Suppose I am a shareholder of a company and I hold at least 20% of the equity shares. Or I can say I hold certain shares which carry at least 20% voting power. Right? Voting power is more correct word to explain. But why I explained shares first? Because you understand shares more, right? And with shares only you get voting power, correct? So, if I am a shareholder of a company and I hold at least 20% voting power in the company, then I am an individual who has substantial interest in the company. Like Mukesh Ambani holds 48% shares and even more voting power in Reliance Industries. So Mukesh Ambani has substantial interest in Reliance Industries. Similarly, if Adani holds 72% voting power in Adani Group, then he has substantial interest in Adani companies. Like that, you should be able to understand. Suppose it's not a company, but it's just a partnership firm, right? In that, obviously, profit sharing will be there. So, partnership firm means profit sharing. So, at least 20% profit sharing if I have, then I am a person having substantial interest in the firm. This way we should understand. Now, we discussed relative, we discussed person having substantial interest. Now, let's come to related person definition. Now, it's a long page, but don't worry. No need to understand it in so line to line depth. Feel it, that's more than enough. From our exams, they'll simply say a person has substantial interest, person is a relative, like that they will give the words, and then we have to add back unreasonable payments. So that's why this whole page doesn't make much sense. But still, general knowledge, so I'm telling. You are an individual. In that case, obviously, your relatives means brother, sister, lineal ascendant, descendant, spouse, correct? And suppose you have substantial interest in another entity, then obviously related persons, correct? Come to company, directors of the company, and their relatives. Hey, for company, please remember, directors of the persons and their relatives are related persons, right? You would have heard about Chanda Kuchar. She gave loans to her husband's company. She developed ICICI Bank to next level. But because she was involved in something, giving loans to her husband's company, even though Videocon did not have that credentials to take the loan, she got imprisonment. She was punished under the Companies Act. So what happens? Directors and their relatives. So ICICI director Chanda Kuchar and her husband is relative. Correct? They are all related persons. Right? Substantial interest, 20%. Now, if suppose X Limited is a company, it holds 20% or more voting power in Y Limited. Similarly, X Limited holds 20% or more voting power in Z Limited also. In that case, X is obviously having power in Y and also has power in Z. But Y and Z both are related persons. Y and Z both are related persons. So X and Y is related, X and Z is related person, but not only that, but Z and Y are also related persons. Similarly, you think about some entity called as firm. Obviously, partners and their relatives are related persons, right? If suppose the partners have substantial interest in another firm, then that another firm and this firm are also related persons. Are you able to understand? That company's example I gave now, X Limited, Y Limited, Z Limited, same way it applies to firm. Okay? Now, come to AOP, Association of Persons. The members of Association of Persons are related persons, obviously. The members' relatives are also related persons, right? And if suppose you have some stake in one AOP and you have some stake in another AOP, then both these AOPs also become related persons. Okay? Come to HUF. HUF means Hindu Undivided Family. Hindu Undivided Family means all the family members are related persons. All the family members are related persons. Suppose one family member has 20% or more stake in any other organization. That organization and HUF are also related persons. This way you should understand. So related person definition, other SSCs is given. Other SSC again spoke about the same things which we discussed till now. What do you remember? देखो यार, very simple. Whole page I am telling in a short way. देखो, one entity, another entity. become related if there is one person controlling both. Correct? Then related person will be if director relative, partner relative, related persons. Simple. This is the crux of the whole content. Now, any excess payment is disallowed, I said. It is automatic or a discretionary power of the assessing officer. Discretionary power means assessing officer has a choice. He wants, he can disallow, add back, or if he don't want, he will not. Like other sections which I said, section 40, small a, clause 1, clause 1a, clause 2, clause 3, 4, 5, all that are mandatory sections. That means assessing officer don't have any choice to decide. But when I say section 40A, 40 capital A subsection 2, it is optional. Assessing officer, if he sees the case, he'll ask you for some explanation. If he is satisfied, he will not disallow anything. If he is not satisfied, he can disallow anything. Sometimes he is not satisfied, still he can ignore also. It is assessing officer's choice. Okay. Now, when I am talking about section 40 capital A subsection 2, I am only talking about payments. Correct? Excess expenditures. Correct? So, don't try to get confused with receipts. Okay? For receipts, for incomes, this section doesn't apply. Right? If you sold some product for a discount, this section will not apply. Right? Because if you sell it for 100 rupees or for 80 rupees, it is not only your choice, but it's a concept of income. So this section 40 capital A subsection 2 doesn't apply. For that, some other sections are there. You are showing low income, understatement of income. For that, there are separate provisions. But here, it is all about expenditure. So whenever you see that there is an income which is less, you give excess discount, ignore, this section doesn't apply. Excess payment, then definitely this section applies. Less payment, this section doesn't apply. Okay? Like this we should understand. Now practically let us see how these all concepts what I taught till now applies. So let us take up a P&L account. Are you ready? Let's see. Hey, I have a small P&L account just to explain this concept. You see sales on the credit side, 5 lakhs rupees. See, interest is given. Then we have certain expenditures like rent. Then we have expenditure like income tax. Then we have expenditure like printing and stationery. Then purchases. Net profit is there. So, after deducting all these expenditure, 1,45,000 profit we got. Okay. Now, we have to compute the business income. Now, business income already whatever is deducted process is done. Why will we do that? We'll only do small corrections based on mistakes. So, we start our business income computation with net profit. So, write down net profit and see 1,45,000. Now, whatever unnecessary expenditures which are debited, which actually should have not been debited, should not have been deducted, that will add back. The problem is solved. Okay. So that's why expenditures debited which are disallowed will add that. Okay. Come to interest. You see that point. What's written in the bracket? You paid interest outside India. Okay. And without deducting tax. Now, which section will apply? Tell me. Section 40, small a, clause I, clause 1. Okay. What it says? 100% of the amount is disallowed. So, what is the interest amount? See? 50,000. So, that's why we added 50,000. Okay. Now come to the second item. What's shown here? Here they showed something called as the rent payment. How much is the rent payment? 60,000. But rent is paid in India, correct? So you paid to resident. But there is a condition that you have to deduct the TDS. Array 194I, 194IB sections are there which tell about deducting TDS on rent. So you did not deduct the TDS as per the conditions. So what to do? We have to add it back. But because it is paid to a resident, will we add entire 60,000? No. The answer is no. Because if payment is done to resident under section 40 small a clause 1a, only 30% is allowed. So 60,000 into 30%, 18,000 should be added back. Now what will happen to this 50,000, to this 18,000? Tell me. Now we added it back. Maybe next year you deposited this amounts with the government. Then what to do? You satisfied the conditions. Next year you claim this deduction, deduct that 50, deduct that 18 when you satisfy the conditions. As of now you did not satisfy the conditions. So you are a non-resident, 100% amount added back, and you paid to resident 30% amount added back. Similarly, we discussed under section 40 small a clause 2 that income tax should be disallowed. So obviously income tax is deducted here. It is wrong. We'll add back. How much? 30,000 added back. Entire income tax. And later on, can we actually deduct it? No. It is absolutely not deductible. So added back. Fourth point you see, printing and stationery expenditure paid to relatives actually. We paid 15,000. But actually the payment should have been 10,000 only. So how much excess we paid as per section 40 capital A subsection 2? We paid excess 5,000 only. That 5,000 only we will add it back. Once we add this 5,000, the answer is done. Next, purchases is given 2 lakhs. Tell me what will we do with purchases? It is a genuine expenditure. It is deductible under section 37. One more thing. If you see all section 40 disallowances, purchases is not disallowed. Okay. If you make the payment or even if the purchases are due, till you can claim the deduction of purchases. Okay. If it is a dummy bogus purchase bills, then some other sections like under 270, they will check. But as of now, it is genuine purchases. It is deductible and in P&L account rightly deducted. Na? So if rightly it should be deducted, they have actually done it in the right way. So do we have to do anything else? Right? In business income computation, we are only doing corrections. Right? Whatever is wrong, we are correcting. So something is right, we'll ignore. Okay. So purchases we have to ignore. So we added these 4 items. Right? Net profit 1,45,000. To that interest 50. Income tax 30 will add. Resident के लिए rent payment 30%, 18,000 added back. And last one 5,000 excess payment to relative under section 40 capital A subsection 2 added back. So when we add these 4 items to 145, we get 248. This is your business income, 2,48,000. So hope you understood how actually these sections are practically applicable, right? What it means and how it should be treated while solving the problems. Both we discussed in this class. In the next class, we'll discuss some more disallowances. Okay? Chal, we'll meet in the next lecture. Bye everybody.